Depreciation in real estate. Is it as bad as it seems? That's the topic for today's episode, and without further ado, let's dive in. Hello everyone, and welcome back to another episode. For those who are tuning in for the first time, this is your channel for real estate education. So today we're going to talk about depreciation. Is it really as bad as some people think it is? And if you don't know what depreciation means, it just simply means the loss of value of an asset due to changes in the market condition or due to wear and tear, right? So let's just dive straight into the word. So typically when you hear about depreciation, you will think about something like this, right? So this is my house that I bought and it was worth, let's say, $100,000, right? But then for whatever reason, for whatever circumstances, the market has taken a downturn and all of a sudden things went downhill. And now my house, instead of being worth $100,000, is now worth, let's say, $50,000, right? But what if I were to challenge you that things don't always have to be this way? Things doesn't always have to be so negative. And yes, while this is a sucky scenario, it's not always as bad as it seems, right? So let's just look into how the accounting side of things actually look like. So let's say you have the same house, right? And then when you have a house, let's say originally, once again, you bought the property for $100,000. But over the years, that value starts to wear down. I wouldn't necessarily say starts decreasing, but starts to wear down because yes, you are using it. So due to the wear and tear, then you start stripping sort of, right, the value of that property all the way down until it gets to zero, right? So in essence, on top of that, you will probably thinking, well, that's a horrible thing, right? But let's just face it, everything wears down. Everything cannot stay new forever. And because of this, right, the US tax code actually takes that into consideration when you're using the properties or any type of asset for the purpose of business. So let's say, for example, your house, you recently bought a house in 2020, it costs you $100,000 and you're ready to put that up for rent. And at the end of the year, you're filing for your taxes and your accountant is gonna come in and say, okay, so you bought this at $100,000. Let's just start depreciating the value of this property. So what your accounting is going to do, depending on the type of property you have, let's say, for example, this is a single family home, and therefore the depreciation for a single family home is 27.5 years, right? So you have $100,000 and then your accountant is going to multiply this by 27.5, and that means we have $100,000 and then we're going to multiply that by 27.5. I had to go get my calculator. That means that your depreciation amount is going to be $3,636, right? So let's say, for example, you bought this house and you decided to rent it out for $1,500. That's the market rent that most people are willing to pay for this one family home. So $1,500, you multiply this by 12, right? That means that on a yearly basis, you're gonna make $18,000, right? So you have $18,000 in annual rent. What would you prefer to do? Would you prefer to take $18,000 and pay whatever tax rate you have, right? Tax rate. Or do you want to take this amount in terms of depreciation into account and then reduce this 18,000 minus 3,636 and pay taxes off of, let's say, 14,363. So now you're noticing that depreciation is not necessarily a bad thing. It's actually a good thing that it's going to work out to your advantage if you were to account for the wear and tear of a property. And you can do that not just with houses, you can actually do that with buildings. The depreciation rate is 39 years. You can actually do that with equipment that you're actually utilizing for the purpose of your business. Now, you'll probably be wondering, okay, that sounds great, but Does it only work for rentals? And the answer is yes. It only works if you were to hold the property for over a year. If you are a flipper, because I know there are a couple of flippers who are watching this channel, you will not be able to do that, because typically when you're a flipper, you buy a property in a poor condition, then you flip it, you make it look really nice, and the goal is to sell it before the year ends, right? And the goal of flipping at the same time is not to prove that you're wearing it down. In fact, you're actually buying the property to bring the value up so you can actually make a profit off of that markup versus from when you bought it to the point that you're actually selling it. So it will not work out for you if you are a flipper. Now, another question that you might possibly have is, okay, I have a house, right? And the house is 100 years old. Does that mean I won't be able to take depreciation off of it? And the answer is no. You will still be able to take depreciation out of the house that you bought for rental purposes. Why? Because depreciation starts from the minute that you're putting that asset to that business, right? So even if the house is 100 years old, but you're buying it, let's say right now in 2020, right? Depreciation is starting off in 2020 because you are renting that property out exactly in 2020. And then you add 27.5 years. So you have all the way until 2047 and, June, 6 months more to take full advantage of the depreciation, right? So there are multiple ways to do depreciation. And in this case, in this one episode, I'm talking about the straight line, right? And that's the one that most accountants use. There are other techniques that are more advanced, and that's certainly not something I specialize. So if you want to explore some other options for the depreciation of your property, I suggest you to reach out to your accountant and get the most information you can to see if this is something that will work out for you or not. And that's pretty much it. It's a short episode. It's all I have prepared for you today. If you enjoyed the content that I shared with you, do not forget to hit the like button. And while I still have you here, I'm gonna let you know that I especially picked this one episode for you that's gonna help you complement whatever you are learning in this episode today. So don't forget to check it out. And until then, I will see you guys next time. Take care. Bye-bye.